go ahead. Yeah. Okay. Anyway, what we're going to do is inventories today, right? Merchandise inventory, right, guys? Okay. And we've got. You guys read this chapter? I hope. Okay. Pretty good stuff. There are going to be 6 different methods. There are going to be 6 different methods. Come on. Might as well just wait for the bus to get here. Right?
We drove.
Oh, we drove.
Oh.
Okay. You said to wait for
Okay, we're doing merchandise inventory. So 2 basic ways that you can account for your inventory, actually control your inventory, right? You could do what? Periodic. You could periodically count. That's what it means. Periodically we count. Anytime we do a financial statement, we need to count. That's it. Okay? All right, although we're going to have some methods of estimating. Okay? We'll get into accounting through 11 in between periods when you count. So we got periodic. That's new to us in this chapter. We haven't been using periodic because most companies nowadays use perpetual, and that's because we have computers nowadays. So perpetual is now less expensive because we're using computers than it used to be, and it's a lot less hassle. It takes a lot fewer employees. Computers do it for us. Okay, we can program computers to do it. Okay, so more companies use perpetual now than people used to use periodic, but still companies use both. So I want you to know what both are. Okay. So this is a real unusual area. Okay? Oh, we're going to do the review on Wednesday instead of today. You guys see my email?
Yes.
Right, you will anyway. One reason is we don't have the quiz until Friday anyway, because we redid things for the snow, I guess. So let's move it later. That's good. That's good. The other reason is I have a board meeting tomorrow morning at 8:30 that I'm not ready for. So that'll give me a couple hours this afternoon to get some financial statements put together for Kentucky Council of Economic Education. So anyway, periodic versus perpetual. Oh, in that review session, we'll probably do 2 hours. We'll do 3 to 5 because the accounts receivable, allowance for doubtful account stuff is kind of complex. Maybe you want to look at a bank reconciliation again, maybe. And then this chapter is kind of complex, right? So we'll probably take 2 hours. Okay. And we'll try to record that too, of course. Okay, anyway, so I think we'll have this room, right? If not, we'll go downstairs, okay? So if somebody's in here, come on down to the 2nd floor. Okay, anyway, so periodic versus perpetual. So this is for merchandise inventory, okay? It's for your merchandise inventory, not supplies or something. Supplies, don't worry about it, okay? We certainly wouldn't use perpetual for that. That's a waste of time. Okay, so we got periodic versus perpetual. What we've been doing so far is perpetual, okay? But with each of these, we can have 3 different ways that we value the inventory, okay? With each of these types of accounting. What are they? What are the 3 methods? LIFO, which means first in, first out, okay? That's it. And it'd be for both of these. Everybody good with that? Okay, for both of them. Okay, and then we have LIFO. And it's for both of these, okay? There's LIFO for both of them, all right? And we have average, okay? We have different names for the averages. In periodic, it is going to be weighted average because with periodic methods, we pretend we buy everything, right, before we sell anything. Because we don't keep track of when we're buying things and when we're selling. Well, really we don't keep track of either one. We record the purchases as we buy them, right? But we don't keep track of on the inventory how much we have. And we don't keep, the reason we can is we don't keep track of what we sold and when we sold, okay? We just wait to the end of the period, periodic, wait to the end of the period and count. Everybody got it? That's the idea, okay? On perpetual, we're going to call this moving average. And the reason it's moving average is because every time I buy something, if it's at a different cost, I know what I paid, I know how much I have, so I figure out what the average cost is each time I buy, right? Changes a little bit every time I buy something. You pay more for it or less for it, than your average, and change your new average, right? So moving average moves every time you buy something. When we sell things, we sell it at that average, okay? Not our sales price isn't at that average, our cost is at that average. Would you ever want your sales price to be the same as your cost? That's a guaranteed bankruptcy, right? Sales less cost of goods sold is gross profit. You're going to have operating expenses after that. You better have more than zero gross profit, right? Or your loss will be equal to your operating expense. So don't do that. And I mention that because students will do that to me, right? Oh, the sales price must be the same as the cost. Like, really? I'm going to do business with you. You buy a TV set for $200 and sell it to me for $200, okay? That'd be great. You're providing a nice public service, I guess, right? As you go bankrupt. Okay, anyway. So we're going to have these methods. So what does FIFO, LIFO, and average mean? And why do they exist, I guess? What does FIFO mean? First in, first out. That means the ones we sold were the old ones, the first ones. So what's an inventory then? The last ones we bought, and this is a real common mistake. People will flip-flop LIFO and FIFO because they'll be thinking about, oh, the name, FIFO. Must be the first ones I bought. No, that's what you sold. First in, first out. The ones you have left are the last ones you bought. Got it? So if you keep that straight, you'll have it made. Okay? What does LIFO mean? Last in, first out. So which ones did you sell? You sold the new ones and kept the old ones. Does anybody really do that on purpose? No. So why does this even exist? And by the way, average is somewhere in between. Average came about because we could use FIFO and LIFO. You're supposed to use one of those methods, but average sort of approximates the two. And before there were computers, it was far easier. Some companies still use it. Okay? Actually, a lot of companies still use it. Okay? But more are on perpetual LIFO than any other one. Okay? Talk about why here. Okay? So let's say you're a dairy. You've been in business for 100 years. Do you really do LIFO inventory? You'd have 100-year-old milk if you did that, right? Because you'd always be selling, right, the new stuff and keeping the old stuff. Imagine drinking that stuff if they ever depleted their LIFO layers. Nobody does that. What do? They always try to sell the old product before the new product. It's true of virtually everything. Automobiles. What does an automobile dealer try to do? Get rid of last year's model, right? They'll discount it dramatically. You should always buy last year's model when it's still new, when the new ones are out on the lot. That's a heck of a time to my wife, and she always like, oh, there's something better about this new one. I'm like, yeah, it's a lot better. They made it look a little tiny bit different. They added a couple of new options that are really kind of cool, right? You know, a little more technology, and it costs $10,000 more. That one's 30, the other one's 20. When we bought our little Miata, I paid 21 or something for that thing, but the sticker price was 31. And the new ones they had were about 34 or 35, and guess how much they wanted for them? 34 or 35, because they were brand new. Are you kidding me? The top came off on either one of them, right? You know, same engine, same transmission, same car. Mine was a year old and set up a lot for a year. 0 miles on them, just like the other new ones, right? Who cares? So use your head when you're buying stuff, right? But don't buy milk that's a year old, okay? I don't recommend that. Don't or bread or something. So nobody really does their inventory. LIFO, what's it for? Taxes. Congress, in their infinite wisdom, wrote the tax law to give people a break on their taxes, right? Which people like this break. It's really good. Every single president, every single one since they passed this law has wanted to get rid of the law. Congress won't get rid of the law because business loves it, right? And it does encourage, I don't know what it encourages. It encourages people to go into business, kind of, to get a big tax break. Yeah, I guess, kind of. Okay, this was kind of silly. What happens when you have, what the law says is if you can either use FIFO or LIFO, but if you use LIFO for tax purposes, you must also use it for your financial statements. That's the real reason people use LIFO. What does LIFO do? Last in, first out. So say your costs are going up on the inventory items you're buying. Where do those end up, those inventory items, the cost of those inventory items? On your income statement. Cost of goods sold higher on your income statement. Which makes what? Gross profit less, net income before tax less, and what does it do to your tax bill? It makes it less. By the way, do you avoid the taxes forever? No. What about if they call it liquidating, you read about that, liquidating LIFO layers. What if you start selling off that old inventory? You don't really have old inventory, but those old costs. What if you start selling selling it down. What happens? Now your cost of goods sold is what? Real low. Your net income's high and you pay more taxes. So later you might pay taxes on it. By the way, when do you end up paying that tax? Probably your business is failing a little bit, right? Your product's becoming obsolete, it's being replaced for something else. You're probably not as profitable as you used to be, and now you have a big fat tax bill. I've had clients before, small businesses, that got themselves in a lot of trouble with this. Save the savings, right? And invest it. So let's say, by the way, would you rather pay $100,000 in taxes this year or wait 20 years to pay? Time value of money, we're going to do it real soon. Yeah, I'll wait 20 years, don't you? Interest-free borrowing from the federal government for 20 years, I'm on, right? I'm going to do that. Or millions. It's billions in our country, guys. Billions of uncollected taxes. It's not illegal. It's not unethical. Congress wrote the tax law on purpose that way, and people take advantage of it. It's just fun. I always recommend to all my clients use LIFO, right? Okay? Even we're using LIFO for real life and, stuff goods, but we use LIFO for financial statement purposes. Why? Because you have to in order to use it for tax returns. You got to use it for financial statement. What's interesting, though, is we get around that, too. We've got a way to get around that. We'll talk about that later. Okay? So we use LIFO officially, but we tell everybody what income would have been if we were using LIFO. Right? We use LIFO allowance. Okay? So anyway, so the reason you do this is to save tax dollars, but save the money, right? Invest it, because later you're going to have to pay the taxes someday. Right? Make sense? Okay? Don't pay it out in dividends or whatever. Okay? So anyway, so you got the idea of FIFO versus LIFO? By the way, if you're going to be an accountant, you're going to take the CPA exam someday, you don't tell them it's because of tax law, because we don't want to do accounting because of tax law. Right? Not really. So there is some truth to this. FIFO gives me a better number on the balance sheet. You agree with that? More recent costs on the balance sheet. But it gives me a slightly diminished number, not quite as good a number, on the income statement because my cost of goods sold are older costs. Got the idea? LIFO's the reverse. LIFO gives me better costs on the income statement, closer to replacement costs, right? Because they're the most recent purchases going in there. And then what ends up on my balance sheet? Old costs. The problem is they get older and older and older and older. Imagine if you held the inventory for 100 years, what the cost is for 20 years, even what the cost is compared to now. Got the idea? And people actually have financial statements that are like that. So their inventory and balance sheet doesn't really reflect value at all. Okay, at some point. Okay, anyway. So that's the idea with these, you guys. Why do I want you to be able to do all 6 of these? Periodic FIFO, LIFO average, and perpetual FIFO, LIFO average, because companies use them. And it makes a difference in their inventory, and therefore a difference in their cost of inventory in the balance sheet, therefore a difference in their cost of goods sold, which makes a difference in net income, which makes a difference in equity, right? Okay, so you need to know what company's using so you can sort of evaluate one company relative to another. Okay, really useful. Okay, anyway, and also you're going to be making choices yourself about which methods to use and why, okay, what you might want to do. Okay, so we'll go through the accounting for periodic versus perpetual. Oh, you asked a question before class started. It's a really great question. He says, isn't FIFO periodic and perpetual exactly the same in terms of the balance sheet inventory amount and the cost of goods sold? The answer to that is yes. By the way, it's far easier to calculate periodic. So if I were to ask you for perpetual FIFO, I have a recommendation for you. Calculate it periodic and give me the answer. If I ask for both, which I do a lot of times, on that practice quiz I gave you, you take a look at that, ask for both, didn't I? And they're exactly the same number. That's how you knew it's the same number. Huh? You said, well, wait a minute, what's going on? Yeah, it's the same number. Kind of nice. But did you calculate it 2 different ways? One's periodic, one perpetual? Go through the... Yeah. Which took you longer? Yeah, so next time done. Right? Just do the periodic and write the answer down for both. It's going to always be the same. The reason is with FIFO, you're always selling what? The first ones you bought, the old ones. And you're keeping what? The most recent ones you bought. Okay? So it'll always end up being exactly the same. Okay? Right? Let's see. All right, so let's do journal entries first. Okay? Periodic is new to us. Perpetual is what we've been doing all along. Okay? So you already know how to do perpetual. We just didn't call it that. That's kind of cool. So we're only adding one method of accounting here. perpetual, every time we buy something, we add it to our inventory. Every time we sell something, we take the cost out of our inventory. So we always know how much we have. Right? Now with computers, with scanners, it's just not a big deal to do this anymore. Right? Anybody work in a warehouse or a store or something in here? Okay. So you've probably seen this. When goods are delivered, they're on a pallet probably, right? Or in a truck. And in any event, the pallet will have a barcode on top of it, right? Which tells what? The computer, what's on that pallet, right? And then they have the pallet shrink wrap, typically, to try to keep people from moving things around or stealing things or whatever, falling apart, obviously, too. The boxes falling off or whatever they are. Okay, so they're trying to control that inventory, aren't they? So when they bring the pallet in, or if it's the whole truck, it could be a whole semi with a barcode on top of the semi. I'm not kidding, right? When you pull in, there's a scanner on the ceiling, that reads it. It automatically debits inventory and credits accounts payable. Doing the journal entry, no kidding, right? And it updates every single inventory record. So there might be 50 different types of inventory items on that pallet. But what happens? It adds the count of all of them to the inventory. Everybody got the idea? All right? Then when people leave your store, what happens? Or you take something out of your warehouse and you send it to your customer, what happens? You scan it, don't you? And when you scan it, what's the computer doing for you? If it's a store, let's say it's Target or something, you're taking something out of Target, they scan it, credit. It's going to do what? It's going to credit inventory and debit. What is it? This is perpetual. Cost of goods sold. Don't explode. So when you buy stuff, it debits inventory and credits accounts payable. And then later you pay out the account payable, right? What do you do with that? Debit. Accounts payable. Credit cash. Come on, you guys. Right? You know that. Okay. On the sale, what do you do? For the sales price, right? If you're taking it out of Target, what are they going to do? They're going to debit cash and credit sales for the sales price, aren't they? What are they going to do for that inventory item? That's part of scanning it. They do that, right? And then also scanning it, what do? Debit. For the cost of it, what do? Perpetually, you guys. What we've been doing all along. Your customer is walking away with the inventory. Well, what are you going to credit then if they walk away with the inventory? Inventory. What are you going to debit? Cost of goods sold, which is an expense account, right, guys? Everybody knows this? You were formulating that answer. You're just torturing me today. Is that right? Okay, good. All right. She's shaking her head yes. I refuse to answer your question. Okay. All right. So here we go. It's really nice if one person says something. Yeah, okay. Two of you. Okay. As long as you're formulating the answers, I'm fine. So let's say that we start a new business. We've got no inventory, okay? Obviously, if we start a new business. So we've got inventory with nothing in it. So I guess perpetual inventory would have nothing in it. By the way, beginning inventory is always last time's ending inventory. Everybody agree with that? That's true, isn't it? Okay? And we have cost of goods sold, right? That's the expense account. Okay? And cost of goods sold would start with how much in it if you start a new year or start a business, either one. Because you close that, right? So both of those would be zero to start a new business, but cost of goods sold would be zero to start a new year in any event. Okay? In periodic, we're also going to have inventory. It'll have nothing in it. But we aren't going to use cost of goods sold. Instead, we're going to use an expense account named purchases, okay, where we keep track of our purchases, okay? That's how this thing's going to work. So let's say that we buy $100,000 worth of inventory. What do? Under perpetual, what would you have done, guys? This is merchandise inventory. We usually call it that. Doesn't matter. What's that? Yeah. Debit merchandise inventory for the 100. Absolutely. That's what you do. So we debit merchandise inventory for 100,000 with it. And what would you credit from? Business to business. It's almost not a count, right? Unless you don't trust them. And then they don't bring cash. When they pick up the inventory for 100, they don't give you 100,000 bills. They pay you in advance then when, right? That's how you work that. But anyway, if your normal business is the accounts payable in it, you guys know this. Let yourself use it. It's nothing new. It's nothing new. Okay, so we got the inventory. What would we do under periodic? What's different under periodic when we buy? You don't debit inventory because we are not keeping track of how much we have. Got it? That's it. So what are we going to debit? I purchased it. Debit purchases for the 100,000. Credit what for 100,000? We owe it to them. Accounts payable, and later it'll be debit accounts payable, credit cash, right? When we pay for it. Okay, guys? We got 100,000. And by the way, the beginning balance in that would be 0 too, wouldn't it? Expense account. Okay, always be 0. All right, so that's where we're at. So now let's say we sell something. Okay, let's sell 85,000 of that. Make it different than the other example. Okay, 85,000. Okay, let's sell 85,000, and let's sell it for $110,000. So I'm going to sell 85,000 of inventory for $110,000 on account. Give me the journal entries for that under perpetual. You already know how to do perpetual. That's what we've been doing. I sell on account 110,000. Debit what? Accounts receivable, of course. 110. Credit what?
Sales.
Well, I'm going to credit inventory later, but for the sales price, what would it be? Sales. Sales revenue, guys, right? You can call it sales revenue if you want, or just sales. Okay, it is sales revenue. Everybody with me on that? What would I do if I was periodic? Exactly the same thing. Okay, so this is just not a big deal getting the differences. So if I've got purchase versus merchandise inventory, that's one difference, right? But when I record the sale, it's still the same sale. I still have the same account receivable, 110,000, right? And I still have the same sales. Everybody got it? This is just not a big deal. If you have not read this chapter yet, you're doing yourself there. Okay? Get it read, pound on it. Okay? Get this down. Okay? So, yeah, debit accounts receivable credit sales for 110. Now what? Under perpetual, you wanted to get your credit inventory, didn't you? Because you want to perpetually keep track of how much you got. What did I say it cost, the inventory cost? 85. Okay? So my sales is 110. My cost is going to be 85. Where am I going to put the cost? What account? Cost of goods sold. Absolutely. Cost of goods sold is going to be 85,000. And what kind of an account is that thing? Expense. Yes, I got 85 in here. So sales of 110 less 85 cost of goods sold is what? Gross profit of 25. Right, guys? Gross profit of 25. What would I credit for 85? What am I going to take it out of? Merchandise inventory. You got it. Okay. 85 coming out of merchandise. Everybody good so far? What do I have left in merchandise inventory? 15,000. Okay. What would I do on the periodic side? Nothing. No entry for cost of goods sold. I'm not perpetually keeping track of my inventory. What I do, okay, so let's say that's the whole year. Really, it was a whole bunch of journal entries, right? At least one per day, okay? Right? Journal entry after journal entry. And they totaled 100 of purchases and 110 of sales and 85 of cost of goods sold. So that's the total. So where am I at right now? I've got 100 in purchases, right? I've got inventory with nothing, right? If I'm periodic. I've got 15 if it's perpetual and 85 cost of goods sold, right? Everybody good? So perpetual, I know where I'm at. So here, what's the big advantage of perpetual? I always know where I'm at. For each one of my inventory items, I know where I'm at, right? Have you ever gone to a store, you know, a clothing store or whatever, furniture store or whatever, and you're buying at a mall, and you're buying something, and they don't have, let's say you're buying a, I don't know, let me give you a guide this time. You're buying a shirt. You buy your own shirt, your mom buys it for you. My mom buys it for me. I haven't bought clothes in many, many years. My mom's really my wife. Right? She buys. Okay, so you like my wife's taste in clothing? I didn't pick any of it. These young ladies are making their taste in men is real good. Right? Yeah, sure. Anyway, so that was at least funny. That was more. Okay, anyway, so you go, you're going to buy a shirt, right? It's ever happened. Anyway, they don't have your size. But they say, oh, at the other store across town, we've got it. And I guess you really want this shirt bad. Okay. Right? And the shirt? Yeah, good. All right. It'd be my son-in-law, his shoes. That's a better shoes. Athletic shoes. Got a couple hundred. $2,000, $4,000 collection of shoes. Yeah, so, but strange to me. Before I got married, I had one pair of shoes until it wore out, and I have one more. How many shoes can you wear at once? Well, no, I have two shoes, not just one. Yeah, one for you. Yeah, maybe. So. Now I have I don't know, probably 10 pairs of shoes or something. For me, kind of in a way. So, all right. The shoes that you want, they don't have in that store, but they have your size in the store across town. So you immediately get in your car and you go there, right? No, you don't. What do? Because they look in the computer and they're supposed to have it. What do? You ask them to go check on the shelf. No. Well, wait a minute. They have a professional inventory. Why do you do that? Because they might or might not have it, right, guys? The records don't have to be right. And to make the records right, what do you have to do? Every time you buy something, you have to put it in the inventory account, right? Every time you sell something, you have to take it out. Every time you move something from one store to another, you have to take it out of one inventory and put it in another inventory. Got the idea? If you don't do that in terms of recording it, do you know how much is in the store? No. Is it important to actually record the movement of the goods? Yes, because you'll piss off your customers otherwise. Wouldn't it be nice if they told you it's at the other store and you didn't have to bother to have a call? What they'll probably do is call and they might tell you, I know it's there. Our records are really good. We're really careful about this. But I'll call. And they call, and of course they're there. Right? You set them aside for you, you go pick them up at your satisfied customer. Or they send them straight to your house. Right? Okay? Everybody got the idea with this thing? Okay? Important to have these records corrected. Right? Because it'll piss off your customers if you don't. Right? What if you're periodic though? All you can do is go see if it's on the shelf. Because you don't know otherwise, right? So in a real small business, might you still be periodic? Yes. In a big business, you think Target wants to be periodic? Oh my gosh, they'd go crazy, right? They wouldn't know where anything is. You wouldn't know where you're at. So the big advantage of periodic is it's what? Cheap and easy, right? Before there were computers, boy, it was a big difference too. With computers now, not such a big difference. What's the nice thing about perpetual? You know where you're at. You can run your business. So obviously, most companies of any size at all are going to be using perpetual, don't you suppose? You know what though? If I'm selling corn, ears of corn, and I have them piled out in a field, have you ever seen the big mounds of corn that they'll pile out in the field, right? Put tarps over them and stuff? Do that with wheat too. You ever see the piles of wheat out on the West Coast? They're growing wheat in Western Oregon. Western Oregon. Unbelievable, right? Apples. Apples, before they actually put little stickers on them for the barcode on them. Kind of funny, right? That's actually a different story. Maybe not. Okay, maybe it's being done by the apple growers now. Okay, but if you've got something like that that's a fungible good that all mixes together, do you want to put a barcode on every grain of wheat? Probably not. Guess what they're going to do? They're going to use periodic. They will. Okay, and then maybe some modification of where they keep track of how much they're weighing or how much they're taking out, that sort of thing, like tonnage or something. Okay, bushels or something. Okay, anyway. So that's sort of the idea. So here we're supposed to have 15. By the way, will you necessarily have 15? Only if your records are perfect, right? You won't necessarily have 15 left. And in both companies, this is the same company, so both ways you'd have 15, wouldn't you? If your records are perfect, you'll have 15. Do you think you'll really have 15? No, probably you'll have less than 15. Why? Because people steal. And also people damage things and not report it. Have you ever seen anybody go into a convenience store and grab a six-pack of beer and run for the door? Most of us have seen that. I hope you haven't done it yourself. Yeah, maybe yeah. Okay, I hope not. Don't do it. Don't ever do it again. Okay, terrible. Okay, and go to jail too. Okay, for two reasons: underage and theft. Yeah, that'd be great. Okay, so anyway, so have you ever seen anybody though grab it or steal it? And then stop at the checkout stand and say, hey, I'm going to steal this, but I want you to update your inventory records so they're not screwed up. That one doesn't happen, right? Okay, so the stuff that's stolen, we don't know. It's just stolen. With periodic, you're not going to know about it. With perpetual, you might notice why. Because you know how much you're supposed to have, and you can look count. So you still count, got it? You count with either method. A lot of people think, oh, with perpetual, you never need to count your inventory. You'd never know how much to have over a period of time, right? You have to count, see how much was stolen. The other thing is, you suppose forklift drivers actually drive over cases of product every once in a while? Yeah, it happens. No matter how careful they are, it's going to happen. Things get damaged. If they have a good manager, what happens? They tell their manager, and the manager updates the inventory records for it, right? What if they have a horrible manager who's going to fire them for every little mistake they ever make? They're going to clean that up as fast as possible, throw it in the dumpster, and not say a word, right? Be a good manager, guys. Otherwise, you won't know what's going on. Because your employees won't tell you what's going on. Because you're going to punish them every time something goes wrong. Wow. So you motivate people, you encourage them. Now, if she's driving forklifts around for me and every 15 minutes she runs over something or someone, we'll probably have her quit driving a forklift for us, right? Maybe not even work for us anymore. But if it's, well, not a human being, so I'll never run over one of those. But, you know, if she damages a case of product, you know, once every 3 months, so what? Right? If not, you're moving too slow, probably, huh? Nothing ever goes wrong. Geez, you're probably not getting anything done. Okay, so anyway, so be a good manager. Point of that. All right, anyway. And by the way, does accounting have anything to do with running businesses? It's the only reason to do it. Right? To run your business better. That's all it's for. By the way, which do you think would be better internal control of your business? Better control of your business, perpetual or periodic? Knowing what's going on versus not knowing. Knowing where you're at versus not knowing. I'll take perpetual, huh? If you're using periodic though and you're a real small place, what could you do every single day? In bars, they do this. They are not on perpetual, which they're usually not in a bar. What do they always do? One of the things people tend to steal is alcohol. I use the example of beer. Well, in restaurants and bars, they really protect the bottles of booze, water, of all different kinds. People will take them away, and they cost money too, right? To protect the money. So they actually measure how much they've got left, do an inventory at the end of every single day. They actually count every day. Well, so that's periodic, but the periodic is every day, right? They're not doing financial statements every day, but they want to protect their inventory. What if you have a fine jewelry store? You know, you might check your inventory more often than, you know, counting it once a year? Yeah, probably so. How about if you sell green beans? No. Less often, don't you think? Right? People aren't stealing green beans too much, probably. Okay, anyway. All right, so what would the financial statements look like with both of these? Let's say that, for now, let's assume there's not anything stolen. When we count and have exactly 15,000. What do you need to do? On this periodic up here, we've got, that side was periodic, right, guys? We've got inventory of 0. If we went and counted and there was 15, what do we need to do? We need to record 15 in there, don't we? For our balance sheet. So I think I'm going to have to debit this for 15,000. So here's one more journal entry you're going to have to do if you're doing periodic. This side was periodic. Just went off the screen. This side was perpetual, right? Okay, so here we go. All right. They're going to have to do one more thing. They're going to have to do an inventory adjustment, and this would be part of their closing entry. You guys remember closing entries, right? We just did them in chapter 4. Whoops, inventory adjustment. We are going to debit this inventory adjustment. We are going to debit merchandise inventory. How much? That's merchandise inventory. We want it to be 15. It's 0 now. 15. By the way, what if it was already 10 and you want it to be 15? Debit it for 5. What if it was 20 and you want it to be 15? Credit it for 5. Adjust it from where it is to where you want it to be. That's all it is. This is an inventory adjustment, you guys. And we will credit income sum. Now, there's a variety of ways you could do this, but this is one your author shows you, and it's just fine. You could also go to cost of goods sold, look at closed purchases, the cost of goods sold, end up with cost of goods sold, the same as if you were doing periodic, or perpetual, rather. But this is one way. This is fine. So I'm going to have this credit balance in income sum right now, right? So really, what's going to go on my income statement is the 100,000 of purchases less the credit on income sum. What I sold is how much I bought less the increase in inventory. Would you agree that if you bought 100 and you still have 15 left, that you must have sold 85? What if the inventory goes down? Say it went down by 5. You must have sold the 100 you bought plus the 5 that you took out of inventory. Make sense? Be 105. So this is going to work really good. And here's how we're going to do it. Okay? If I was doing perpetual, I would show my sales. So this is my income statement. I'd show my sales. How much was my sales, you guys? 110. See that? Okay. And then I do cost of goods sold. Well, I already know what my cost of goods sold are, don't I? How much are they? 85. Everybody agree with that? Okay. So what would my gross profit be? 25. Okay. And take away my operating expenses, take away my income tax expense, I get my net income, wouldn't it? Everybody agree? So how's it going to work? So I got the 25 here. But you know what? Disclosure is going to require, and they showed you this in the book, right? Disclosure is going to require for cost of goods sold that I show what it's composed of. Beginning inventory, which in this case is 0 because it's our first year, but it'd be whatever the beginning was, right? Plus your purchases. How much are our purchases? Well, the purchases that came in here were 100. We know they're 100, don't we? So plus 100. So what's available? You know, if you start with nothing, this is rocket science, by the way. Your beginning inventory plus what you bought is what you have. Beginning inventory plus purchases is what's available for sale. Would you agree with that? Always true. Okay, it's common sense. So if I start with nothing and I buy 100, how much do I have available? 100. And then if I subtract what's left at the end, what it's going to give me is what I don't have left, right? Which is what? It's gone. Where'd it go? I sold it to my customers, and it is called cost of goods sold. Just simple. So how much is my ending inventory? What did we say it was? 15. So if you take 15 away from 100, what do you have, everybody? 85,000, which is the cost of goods sold. Okay? So I'm going to show this in the income statement. Now you're not going to believe this. What are we going to do if we do the income statement over here on the periodic side? What's it going to look like, everybody? I'm going to start with sales. What's it going to be? Same company. It's 110, right? Here's my sale. Then I'm going to do cost of goods sold. How are you going to get cost of goods sold? What are you going to do? Beginning inventory. What was it? 0? Right? You're going to add your purchases, but this time the purchases aren't up there in the inventory account. Where are they? They're in the purchases account. So you just take purchases from the purchases account. Big deal. It's the same amount. It's 100. What's available for sale? 0 plus 100 is 100, right? What's my ending inventory? It's in the inventory account. It's 15. It's the same either way. It's the same company. Two different methods of accounting for it, right? So the ending inventory would be 15. Take that out of there, and what do you have left? Cost of goods sold to how much, you guys? 100 less 15 is 85, isn't it? And there we are. Okay, and then what? You take your sales of 110 less the 85 cost of goods sold, and you have gross profit of how much? 25. So we will get exactly the same income statement either way. Got it? Then when we close the books, what we're going to do is we're going to close this 15 in income summary, and we're going to close the purchases of 100. And what's the difference between those two that's going to go to retained earnings? We're going to close them both to retained earnings, right? First purchases will also go to income summary. And then we'll close income summary to retained earnings. What's in income summary, by the way, when we're done? Before we close it to retained earnings? What's in there? When you do those closing entries, what's in there? Net income or net loss, right? And what do you do with the net income or net loss that's left in income summary? Close it to retained earnings. Go back and look at those closing entries a little more. Okay? All right? Okay. By the way, how do we close? All the revenue accounts have credit balances, and the gain accounts have credit balances. How do you make them 0? Debit them for their amount, right? All the expense and loss accounts have debit balances. How do you make them 0? Credit them for whatever amount's in there. What's the difference between the revenues and gains? Revenues and gains less the expenses and losses. What is that called? Net income. That's what will be left in income summary, huh? Then what do you do with that amount? Make it 0 by closing it to retained earnings, the equity account retained earnings. Got it. That's it. Go back and play with that a little bit. This is just expanding that a little bit, okay? Adding this inventory adjustment here. Okay? Everybody see it? Not too bad, huh? Well, in real life, when we count, do you suppose we'd get that 15? If we had the situation where we think the inventory is 15, do you think it really will be 15 when we count? Or will there be some theft and some damage that wasn't reported to us? Probably. Usually you won't have more than the inventory that you have on your books, but you might. How could that happen? I count and I have 16,000 instead of 15. How'd that happen? I count it and take the cost times the units of the inventory I have, right? The units times the cost of the extension, and you add it up, and that's the total dollar amount of the inventory. Makes sense? You might have thousands of different inventory items. Count each one, times what it costs you for each one, using FIFO, LIFO, or average. So I use those whether I'm periodic or perpetual, either way, right? So I value out my inventory, right? Quantity times the cost per unit, and get that extension, and then add them all up, right? If I have 1,000 inventory items, I add up the cost of all of them that I still have, and that's my ending inventory. Make sense? Okay. So what if I count and I have 16? What might have happened? You must have made an error recording what? How much came in? You recorded too much coming in. Or how much came out? You recorded too little going out. Could that happen? Sure. So that could happen too, of course. But what's more likely? You'll probably account for things coming in and out pretty good, for the things you know about. If you're computerized and you're careful, your program, they're pretty good at getting recorded what comes in, and they're pretty good at recording what goes out. Are they good at recording what gets stolen or damaged? Not always. So they'll know how much was lost. What if you have a fire and one of your warehouses burns down? How can you estimate how much is gone? Count the inventory that you have left, right? Compare to your perpetual record, and you know about what the loss was. Got it? What if you don't have a perpetual record? Oh well. Right? You don't know. Everybody got it? So perpetual is a lot better for controlling your business, obviously, than periodic. Okay, so what would I do? Let's say it's 16. Let's kind of start that over. Let's say I've got this situation where my inventory, I had 15 left at the end, so there's 15 here in my general ledger, right? And I now know that, let's count it, let's say we only had 14. Everybody got the idea? So this is my count. This is my perpetual record, okay? So this is perpetual. Okay? And let's compare that to periodic again. So in periodic, I would have an inventory account. Before my adjustment, it would be 0, wouldn't it? Before I adjust it all, before I count it. And then I'd have a purchases account that would have my, what was it, 100,000 I bought? Okay, so that's where these accounts would be, huh? And now I go count and I find out there's 14,000, not 15. What do I need to do? Well, under periodic, I'd still do my inventory adjustment, but what would my inventory adjustment be? Debit inventory, but for how much? If I counted 14? See, I don't know that it should have been 15 because I'm not using perpetual, I'm periodic. So how much would I put in there? 14, right? Everybody agree? So my entry would be, for the closing entry, for my inventory adjustment, it would be debit inventory, merchandise inventory for 14,000, wouldn't it? And credit what? Income summary for 14. So where's the 1,000 that disappeared? Oh, it's going to be in cost of goods sold, isn't it? This is what I'm going to show for cost of goods sold. 100 purchases less the change in inventory. It'll be beginning inventory of nothing in our case here, right? Plus purchases of 100,000 in our case here, right? Available is going to be what? 100,000. But now if I think my ending inventory is only 14, I'll subtract 14, won't I? Right, guys? And what will I have for cost of goods sold now? 86 instead of 85. So where is the stolen or damaged inventory? It's included in what? Cost of goods sold. Got it? It's going to just fall out there. I won't know if some was stolen or damaged. Got the idea? Stolen, lost, whatever. Okay. All right, on the perpetual I'll know though. How will I know? I've got 15 in the inventory account. I had cost of goods sold was 85, wasn't it? Okay? The way I got that was I started with nothing, I bought 100, right? I sold 85, and that's how I got the 15 in there, wasn't it? Okay, all right? So I know cost of goods sold is 85, so what's the other 1,000 that's coming out of here? Two things you could do. I know 1,000 is missing, so I've got to reduce the inventory from 15 to 14. So I could reduce the inventory by 1,000. And I could debit, if I think this is an immaterial amount, I could debit the cost of goods sold. I think, what do I mean by immaterial? So I'm now going to make cost of goods sold 86,000. Got the idea? I just added the cost of goods sold, and I'm there. And I've got the 14 in here. What do I mean by immaterial? It will not make any difference to a rational decision maker, a rational person using the financial statement. They'll think the $1,000 just doesn't matter. Okay? Small enough that it won't change their decisions. That's what materiality is. So if I think it's immaterial, right, not material, immaterial, I will go ahead and put it to cost of goods sold. What if I think it's material, though? What if it were material? I could credit inventory, say it was 10,000, right? It's a big number, okay? I could debit loss on theft of inventory, loss on damaged inventory, loss due to fire, whatever it is, however I lost it. Got the idea? And that loss, instead of cost of goods sold, I'd keep my 85 cost of goods sold then. That loss would go where? You could put it down in non-operating, right? Not extraordinary item, right? Not unusual and infrequent. You read about that, didn't you? Right? It's not unusual and infrequent, so it's not extraordinary. But what is it? Either unusual or infrequent that I have this, perhaps, and I would put it down in non-operating, okay? Instead of having it included in income from operations. Or you could show it under operating expenses separately, that way too. Or you could show it right next to cost of goods sold. You have a line cost of goods sold, the next line could be lost inventory or something. Any way is just fine, right? Okay, any of those ways. Got the idea? Is this easy or what? Or what? Next time what we're going to do, and then we'll do it too in the review session, is we will do FIFO, LIFO, average, periodic, and perpetual, all the methods. And that'll take an hour of cranking. Try and do the quiz first. Try and do problems in the book first before I see you on Wednesday. Okay, guys? Geez, we're leaving early, and we started late. Terrible. Terrible work ethic. Yeah. I guess we got 47 minutes recorded here. We started on time. Okay. So anyway, and I'll try to get this one posted out there if you want to listen to it later, or if you don't want to listen to it. You really don't want to listen to this 3 times.
Already did.
You listened to one from an earlier one? Did I do a better job?
You didn't do as much of this. You did FIFO.
Oh, I did the different inventory methods first? Yeah, I did it in reverse order, probably.
You did this.
I did the quiz. You guys are actually watching these before you sign anything?
I'll watch it before.
Good for you. Watch them on the bus? Good job. Isn't technology wonderful? Where'd you go?
Georgia.
Oh, it's a long trip. You might as well, huh?
Yeah, I did.
Just sleep or goof off. Yeah. So you drove everybody nuts. Probably a headphone.
The last time when I was about 9 p.m.
So the bus had Wi-Fi? How cool.
It's not very good.
My wife and I take Amtrak across country. We've done it a number of times. Not to assist you ever fly with us. Not anymore. So anyway, cost a fortune. I would rather get ships than go in here for passengers. But anyway, you take the train and you wouldn't believe the young people, they just can't believe there's not this Wi-Fi. Because Amtrak can't afford it. Yes, sir. What's your receipt would be in 120? So you want to be 12,000, right?
Yeah, so
It's got a $2,000.
would it be 14?
Yeah, because you got to credit it for 2 to make it 0. You want it to be 12.
Yes, God, I don't know
So
why.
your allowance is going to be 12, but your journal entry is going to be 14. You answered it right.
Okay.
Right? This is wrong.
Yeah,
It's
that's what I was saying.
debit 14,000 bad debt expense. Write your journal entry down. You get it.
Okay.
Debit bad debt expense 14 and credit allowance for 14. Oh no, it's a credit already.
Yeah.
I'm lying. Yeah. You did exactly right. I apologize. If it's a credit of 12 and you want it to be 2 and you want it to be 12, you would credit it for 10, right? Which makes the balance 12. You're right. And the bad debt expense would be 10. So it's debit bad debt expense 10, credit allowance 10, and those are the right answers. Now then on this one where it's got a debit balance, what are you going to have to do? A 3. And I want it to be 10% again, so I want it to be 12,000, right?
Yes. So
If it's got a 3 debit, I'm going to have to credit it for how much? 15. You got it.
Right.
So you debit bad debt expense for 15, you credit allowance for 15, and that'll give you a credit of 12.
So then with the journal entry?
Sometimes I ask for the journal entries, and sometimes I ask for the balance.
Now,
Now, these